In this week's market update, Britain goes to the polls again. President Trump is in the spotlight as former FBI chief James Comey testifies before the Senate. Oil bounces on Middle East tensions, and the ECB and Federal Reserve are both in focus as questions are raised over the pace of monetary normalisation. Now, politics has been a key driver of financial markets over the past 12 months. And this week, we turn full circle with attention back where we started last June in the UK. The first thing to say about Thursday's election is that it's a lot more interesting than anyone expected 7 weeks ago when Theresa May announced a vote that she'd previously said was unnecessary and would not happen. The initial expectation was that the Conservatives would enjoy an easy ride to a much bigger majority than the 17 they currently enjoy. This was certainly Mrs May's plan back in April, and to begin with, that seemed to be where we were heading. But in recent weeks and days, the opinion polls have shown a dramatic swing back to Labour. This could be a lot closer than anyone expected. So what's happened to change a coronation procession into a genuine contest? Well, the most important issue has been the poor performance of Mrs May herself. Having run a campaign based on a kind of cult of personality, she's become almost a liability, outplayed by Jeremy Corbyn, who everyone had written off, but who surprised everyone with his calmness under pressure, conviction and relative normality. The second important change has been an apparent willingness of the British public to embrace the most left-wing Labour manifesto since that long suicide note of 1983 under Michael Foot. Nationalisation, higher tax rates, a splurge in spending, nothing seems to faze us anymore. One key reason for that is the fact that the UK economy is palpably not working for everyone. And as the honeymoon period that followed the referendum last year rapidly cools, it's becoming evident that far from being one of the strongest economies in the G7, Britain is now one of the weakest. Growth is slowing and inflation is rising, and that means that British households are essentially accepting a pay cut at the moment as their real inflation-adjusted incomes lag behind price rises. The third factor is the decision to keep Mrs May out of the televised election debates. While she clearly dislikes the format intensely, this tactic seems to have backfired. The fourth issue has been the government's flip-flopping on key election pledges, notably the so-called dementia tax, which attempts to address a real issue, the growing cost of social care, but it does so in a way that many natural Conservative voters see as unfair. So, there are now four possible outcomes. Still quite likely is a significant Tory majority. Polls tend to underplay the Tory vote and overplay Labour's. It's also the case that Labour's rally is largely an urban upsurge in places like London and Manchester, where the party is already strong. In Brexit voting towns outside the metropolises, May is still considered to be the safer pair of hands. This means the second outcome, a small Tory majority, is also quite likely. This would be extremely bad news for Mrs May personally, because it would throw into question her judgment about holding the election in the first place. It would also fail to deliver her the mandate to negotiate a hard Brexit that she was seeking. The third possibility is a hung parliament. This would also be a disaster ahead of the Brexit negotiations, which are due to start just 11 days after the election. They'll be hard enough for a strong government. One that's propped up by electoral deals, if not a full-blown coalition, will be in a very weak negotiating position. The final option, barely credible only a few days ago, is a Labour win. And this, of course, would have the biggest market impact. This remains the least likely option, but as last year's shocks showed, anything is possible. Whatever happens on Thursday, attention will very quickly shift to the Brexit negotiations. What's clear is that decisions by businesses and individuals will need to be made long before the March 2019 deadline for us actually leaving the EU. And that means that the shape of Brexit must be very considerably clearer within a year or so. This seems extremely unlikely. No one seems to have a plan for what happens if there really is no deal. So, what are the market implications? Well, sterling tends to be the lightning rod for uncertainty, and we're already seeing weakness in the pound as the polls move away from an easy Tory win to something more uncertain. The pound has been remarkably resilient in recent months, but this may not last beyond the initial skirmishes with our European partners. As for the stock market, the new highs being hit by the FTSE 100 are largely a reflection of sterling weakness. This, as we know, is good news for big overseas earners and exporters, so shares may continue to rally even if the outlook looks confused. The one thing to watch out for is what happens if the unexpected does happen and Labour snatches victory. The implementation of the first genuinely socialist agenda in Britain since the 1970s would undoubtedly see a very negative initial reaction. Now, in other news, the US is in focus for a couple of reasons. First, last week's somewhat disappointing non-farm payroll employment data confirmed that the US recovery remains fragile. Adding another 138,000 new jobs in May shows that the jobs market continues to improve, but at a slower rate. That's raised questions about whether the Federal Reserve will maintain its planned tightening trajectory, even though the odds remain extremely short on another hike at the next meeting this month. The real question is whether there are any more hikes this year. The second area of focus in America this week will be Thursday's testimony by former FBI head James Comey in front of the Senate Intelligence Committee. This is his first public appearance since being fired by President Trump, and expectations are high that he will have something interesting, even explosive, to say about the circumstances surrounding his dismissal. The key question is whether Mr. Trump attempted to influence the FBI's investigation into Michael Flynn. He's the former National Security Advisor at the center of a probe into the Trump campaign team's links with Russia ahead of the presidential election. Interfering in the judicial process in this way might be the first step towards an impeachment of the president. The testimony could cap a bad week for the US president, after he was roundly criticised by almost every other country in the world for his controversial decision to withdraw the US's support for the Paris climate change agreements. These seek to limit global temperature rises to less than 2 degrees. Also in focus this week will be the European Central Bank, which meets in Estonia to discuss rates. Europe has been the big economic surprise of 2017, growing around twice as fast as the US, contrary to expectations that America would flourish under an expansionary Trump presidency. Instead, the positive surprises have all come from the Eurozone, with a broad-based recovery that has spread from exports to consumption and investment. The current expectation is that the ECB will continue to look through short-term growth to focus on a continuation of very low levels of inflation and high unemployment. However, at some point, the ECB will have to acknowledge that growth is real and start to taper its bond buying and return interest rates to positive territory. And finally, oil is back on the radar again. Having dipped back below $50 a barrel last week as oversupply fears prevailed, Brent bounced back above this psychologically important level after Saudi Arabia and 3 other Arab nations cut their ties with Qatar. They accused the gas-rich country of fueling extremism and terrorism. Qatar's stock market dropped over 5% on the announcement, while oil rose by 1%.